Hey, let's get into geekonomics here. Professor Richard Wolff is on the line with us. Our friend, the economist, the co-founder of democracyatwork.info, and RD Wolff with 2Fs.com, Prof. Wolff on Twitter with 2Fs. Professor Wolff, we saw the stock market has dropped about 20%. It's now, maybe it's bounced back a little bit, but it was officially in bear territory for the few days. And everybody on television, you know, all the investment people and whatnot were saying, well, you should diversify your portfolio with bonds. So I wanted to do a deep dive into bonds. You know, what is a treasury bond? What's the difference between a bond and a bill? What are these exchange-traded funds, these bond funds? What are corporate bonds, and how, you know, what role do they play in all this, or are they even accessible to average investors? And how can people interact with all of this stuff as part of their portfolios? And are bonds inherently safer than stocks? What's the deal here?
Well, my advice would be not to follow the advice that you've been seeing on television, radio, or anywhere else, because bonds are an instrument that go down in price, down in value, when interest rates go up. Since interest rates are in the process of going up, and Mr. Powell at the Federal Reserve has told us July and so forth, the rest of the year, are likely to be interest rate increases, you would not want to own bonds at this time because they will be going down in value, which, by the way, they've been doing for most of the last 6 to 12 months. So had you been given that advice before, it would have been a disaster. And if you've been given it now, it's likewise a disaster because there's no guarantee that they wouldn't go down in price more than a bundle of stocks now, especially because they've gone down, the stocks have, for a while. But let me answer your basic questions. A bond is simply a loan. Don't get misdirected by the word. It's simply you have lent money to someone if you buy a bond from them, because the bond is like an IOU. It's a piece of paper, but it used to be in the old days. Now it's done electronically, that says that the borrower has received, let's say, $1,000 from you, promises to repay it on a specific date, and promises to pay you interest each year between the time you lend them the money and the time they have to pay it back. If the borrower is the United States government, it's called a treasury bond. It's simply an IOU. You've bought a bond from the United States Treasury. You can do that through a bank. You can do that through a stockbroker if you have one. That kind of business is done all the time. It's a specialized business because it's not a share of a company. It's not a share of the United States government. It's simply a debt relationship. You've lent money, and the federal government owes you that money. It is considered the safest of all bonds because the United States government is presumed not to be in default, presumed to be a safe person or entity to lend to. Or to be more honest, the way to put this is if the government is having trouble paying you back, then getting your money back is going to be the least of your problems because the game is over and your next meal is what ought to concern you.
Right.
Okay, now, second, you don't have to only lend to the government. By the way, the same applies to other governments. You can lend money to the German government or the Spanish government or the Chinese government. It doesn't really matter. All of these governments borrow money and issue bonds which can be purchased by the public. The second thing is a corporate bond. It's exactly the same, except you're lending to a private enterprise, a corporation. You know, like, I don't know, IBM or Apple or Pratt Whitney or you name it. All kinds of larger corporations issue bonds, even some medium bonds. You will sometimes hear a phrase like a junk bond. That's when the bond is issued by an entity that has a very bad credit rating. In other words, it is somebody or an entity, a corporation, a private entity that is not doing real well. And if you go into this business, you should look at the credit ratings provided because it'll give you an idea of how risky the borrower in each case is. But once again, it's an IOU. They pay you interest for the period of the bond, which can be as short as a few months or as long as 20, 30 years and everything in between. And now the last one. You don't have to lend to the government and you don't have to lend to the private sector. You can do one more thing. You can become an investor in what is essentially a fund made up of a whole bunch of these bonds. It's a way, if you want to go into this, to diversify your risk, because you're not putting all your eggs neither in the governmental bonds nor in the corporate bonds. And I've left out also that you can lend bonds to state governments and to city governments. Those are all government bonds, but the only ones entitled to the name treasury bond are when you lend to the federal government, not to the state or local governments. Anyway, if you want to buy and diversify your risk, you can do one of two things. You can buy a mutual fund. There are loads of those. You buy a share of the fund, and then that money is used by whoever runs the fund, usually called the fund manager, and that person buys and sells bonds, and you get monthly checks for your share of the interest being generated by those bonds, and then occasionally you get a bit of a return called a capital gain when they sold a bond for more money than they paid for it. Basically, there you pay a fee, and that fee is what you're paying the active manager of the fund who goes in and out and buys and sells. And finally, the bond ETF. The letters ETF stand for Exchange Traded Fund. Think of it as a mutual fund of bonds. In other words, you're buying something which makes you the owner of a whole portfolio of bonds being managed by whoever sells the ETF. The difference is you can buy and sell it, 10 times a day. It functions on the stock market like a regular stock, even though it isn't that. It's a way of making your situation very liquid. In other words, you can get rid of this bond fund instantaneously by a phone call to your broker like any other stock you might own. And so it was invented some years ago, not that long ago, as a way to allow people to be active on the stock market and yet still participate in something that isn't a stock, namely a fund of bonds, and then the ETF can be in a government bond fund or a corporate bond fund or a state bond fund or an international bond fund. It's a system, and it is available in our society if you are more comfortable with lending to someone and getting, that kind of relationship rather than buying a share of stock, which gives you some ownership and participation in the profits you hope the company will make. Normally, yes, you want to have what's called a diversified portfolio. You want some, if you have money in the stock market, to participate in profit, and then you want some in the more stodgy, slow-moving bond market where you're not participating in anybody's profits. You're simply engaging in a lending kind of game. The problem is, depending on the larger economy, one or the other of these may be safer or riskier. Since we are right now in a bad situation in our economy, bad for stocks, but also bad for bonds, I find it bizarre to get advice to anyone to buy more bonds, because with interest rates going up, that is almost certain to go down in value. If you're very shy of the stock market and you see the logic of what I've just said about bonds, then you ought to do what in other circumstances you wouldn't do. But the advice, and I'm not giving advice because I'm not in a situation to do that. I don't know anyone's particular situation, but if I were to give advice, it would be to hold cash right now, because that's less likely to go down significantly. It will be hurt by the inflation, which makes money less valuable, but the inflation is still going way slower than the crash of the stock market over the last 6 months and of the bond market over the same time.
So I understand that, you know, if I've got a $10,000 bond that matures in 1 year that pays 1%, and the new bonds that are coming out pay 2%, that people are less likely to want to buy that 1% bond from me. So its price goes down in the buying and selling marketplace. Right. But it is still paying 1%. So if I put that $10,000 in, I get, you know, $1,000 back a year from now. So if I'm not buying and selling, isn't a bond pretty much like a CD? I mean, you know, there are inflation indexed bonds that the federal government sells. You can only buy up to $10,000, but you can buy them from Treasury Direct, that are running, I think, 6% now. So actually buying bonds and holding them, as opposed to getting into the trading of bonds, seems like it's sort of like dealing with a savings account. But you can't find a savings account right now that'll pay more than a half a point.
No, that's true, but be careful. Unless you are really keeping track, you can, this line between, you know, what's risky and what isn't is mostly mirage. You could have all kinds of shocking developments either in the stock and bond market or in your personal circumstances. And if you need to have a major operation, or you need to be of help to your children or a relative or a good friend, you may need that $10,000 tomorrow. And if you happen to have needed this at a time when the bonds have dropped down, you could be really hurt. You can't assume everything is going to be all copacetic between now and whenever that bond pays back. Because
it's an illiquid vehicle.
That's right.
I get it. Professor Richard Wolff, democracyatwork.info, the website, or rdwolff.com, Prof. Wolff on Twitter. Professor Wolff, thank you again for dropping by.
My pleasure. Thank you, Tom.